as well as other places. The plan is to walk you through a pretty detailed presentation, and then we're going to migrate to Space. We'll send I'll tweet a link where you can ask questions. So let's begin. Over the past year, the president and other members of the administration have made a number of public statements about Fannie and Freddie that have been, I would say, forward-leaning. The president on May 21st, I'm giving very serious consideration to bring Fannie Mae and Freddie Mac public. I will be speaking with Treasury Secretary Scott Bessent, Secretary of Commerce Howard Lutnick, the director of the FHFA, William Pulte, among others, will be making a decision in the near future. Fannie Mae and Freddie Mac are doing very well, throwing off a lot of cash, and the time would seem to be right. Stay tuned. And the market, of course, responded very favorably to that post. And again, May 27th, a week later, our great mortgage agencies, Fannie and Freddie, provide a vital service to our nation by helping hardworking Americans reach the American dream, home ownership. I'm working on taking these amazing companies public, but I want to be clear the U.S. government will keep its implicit guarantees. I will stay strong in my position on overseeing them as president. These agencies are now doing very well and will help us make America great again. On August 9th, the president put up might call it a meme, showing him ringing the bell at the New York Stock Exchange and something the great American mortgage corporation hinting at Fannie and Freddie and a future listing. Then September 11th, Howard Lutnick did an interview, which we'll play later in the presentation, where he talked about an IPO to create a mark-to-market showing the value of how much value has been created by retaining Fannie and Freddie. And then the president, again, October 11th, kind of compare and contrast under Sleepy Joe and the president, indicative sort of values of Fannie and Freddie. So the president, I would say, and the administration have been very forward-leaning on Fannie Mae and Freddie Mac. Now, the companies, interestingly, the president talks about an IPO, but the reality is that Fannie and Freddie do trade publicly. These are public companies. They trade in the OTC market, or some people call it the pink sheet market. And if you look at the holders list, a number of significant institutions have built material stakes in Fannie and Freddie over the course of the last year or so, Capital Group being the most significant, investing hundreds of millions of dollars in the company, Morgan Stanley, Aegon, Bright House, Banco Santander. Now, again, these are the only institutions that are of scale that have listed their holdings because Fannie and Freddie are not deemed to be 13F securities. There's no requirement that an institution list them in their holdings. So in fact, Pershing Square, which remains a major holder, since these are not 13F securities, we do not make the typical quarterly filings. The other thing, of course, that has happened is Fannie and Freddie have attracted a significant retail investor base, and there's a number of Reddit and other forums, and obviously a lot of commentary on Twitter from many Trump supporters, as well as just a regular way Fannie Freddie shareholders, excited about the potential future of these companies. And the administration has been very clear in its public statements about what it wants to achieve in connection with potential future listing for Fannie and Freddie. Number one, the most important objective is to maintain, or if anything, enhance mortgage affordability. And that really relates to the spreads that Fannie Freddie mortgages trade at relative to kind of the treasuries. And actually, mortgage spreads have been wider than typical in recent years. And if anything, the administration would love to bring those spreads down, reducing the cost of homeownership for taxpayers. The other thing a number of people in the administration have talked about is how do we reflect the mark-to-market value of Fannie and Freddie? Again, the pink sheet market is a much thinner market. There's a limited number of institutions that are allowed to invest in pink sheet securities. So again, being able to demonstrate a mark-to-market, this has really been when the administration has talked about a IPO or a listing of a small portion of the companies. The effort there, of course, was to demonstrate value. And the third objective is to maximize the long-term value of these companies, as these are, a very important asset for the government, and a potential asset that could be contributed to a sovereign wealth fund. Let's listen to Scott Bessent, the Treasury Secretary, as he speaks about his objectives for the two companies.
One, the structure of the U.S. mortgage market. We're committed to making sure that there is no change in the spread mortgage over treasuries. We actually believe there are things that can be done to make mortgages cheaper for the American people. And then on the other side, these are tremendously valuable companies, and President Trump wants to realize some of the value.
And then Howard Lutnick, let's listen to his remarks.
Do I think it's going to be soon? I do. I think it's going to be sort of it could well be a this year thing. Now, do we want to sell a lot? No, no. What we want to do is show a mark to market, right? That the president shows these are assets that we, the American taxpayers, own, and look how much they're worth. Look how well they do. And what we want to do is keep the price of a home mortgage as low as mathematically possible. We don't want to take any action that raises that spread because that makes home ownership tougher. And we want to make home ownership easier.
So what Lutnick refers to here is, what is the timing for an IPO? He's being pressed by the CNBC reporter for an answer to that question. And then he's also explaining the objective behind the listing, the IPO, which is to show the American taxpayer how valuable these institutions are, but only selling a little bit, not selling a lot of stock in the two companies. The president, of course, here reflecting his goal of maximizing value for these two enterprises. He's got a target value for the combined companies of $1 trillion. Our thought with respect to what the administration is trying to achieve is we do not believe that a sale of a piece of Fannie and Freddie to the public is either feasible or really desirable at this moment in time. We think that there are a number of things that need to happen in order for these to have a successful public offering, let alone an offering which will maximize value for the two companies. And in fact, we think an effort to take these businesses public while they're in conservatorship, which is something that's been floated or at least rumored, would lead to likely, in our view, a failed public offering, or just one that would get achieved at a price well below the intrinsic value, very dilutive to the administration's goals of maximizing value for shareholders. In fact, the president has been very public about the fact that he was offered the opportunity to sell these companies for about $100 billion during his first administration, and he rejected that opportunity for his view that these businesses were worth considerably more, and why sell at a below market price. Our view is a transaction today, even one in Q1, which has been discussed, where the largest IPO of all time, we do not believe that will be successful. Why? Because there are a number of things that need to be accomplished. Number one, the entities, the current capital rule requires the GSEs to hold 4.5 percentage points of capital relative to the guarantees they have outstanding. This is a well beyond what I would describe as a fortress balance sheet. And at the current level of G fees, the guarantee fees that the enterprises receive, we do not believe they can earn an sufficiently adequate return on equity to make these attractive public companies. So one, we don't think that's a viable level of capital. Two, we think it's well beyond what is required for these entities to have, well beyond even a fortress balance sheet. In the past, they were clearly undercapitalized with 45 basis points, but increasing the capital requirement tenfold in our view was too high. Again, there have been a number of different market participants, including us, who've argued for a capital level of about 2.5%. But again, the process to determine an appropriate capital level and do it in a manner which minimizes risk to markets, get the necessary buy-in for the market participants, we think is going to take some time. Second thing required is the existing PSPAs, we believe, need to act as a potential backstop going forward. A deal needs to be made there. There needs to be clarity on what powers the FHFA will retain post conservatorship. We think the entities need to recruit and design appropriate compensation packages for kind of best-in-class management teams and boards of directors. And most significantly, all this needs to be accomplished, and the entities need to come out of conservatorship. While they are in conservatorship, the government has enormous powers, over what they can do with the entities, and the board of directors owe their fiduciary duties of care and loyalty solely to the conservator and not to either the company or our stockholders. So I think in that world, to optimize the value of the companies, to do an offering where they're going to sell billions and billions of dollars worth of stock in a transaction, which of course creates legal risk for the company. Each of these objectives need to be accomplished, and it's going to take time for them to do so. So how do we accomplish the administration's objectives and do so in a timely fashion while eliminating the risk that any of these changes could create risk in the mortgage market, which I think is the principal concern of the administration and the Treasury Secretary? The answer, in our view, is a three-step, very simple, straightforward process. The biggest overhang today over the trading price of Fannie and Freddie is the market's concern that there is some probability the administration is going to take their senior preferred stock and just unilaterally convert it into common stock and massively dilute shareholders. In fact, Deutsche Bank put out a report valuing the GSEs, and they assigned a 20% probability to this instant, and therefore meaningfully bringing down their estimated value of the two companies. In our view, this is not a likely outcome. In fact, President Trump's made some important statements to that effect. It also would be contrary to how conservatorships are supposed to operate. But in light of the history here where the Obama administration came in and unilaterally, literally stole 100% of the profits of both companies, there is that overhanging fear that the Trump administration may do something analogous by converting the preferred into common. The senior preferred stock has been repaid with the contractual 10% interest, plus an extra $25 billion. That capital came out of the company with the net worth sweep. Simply what the administration needs to do is just acknowledge the repayment of the senior preferred stock from an accounting perspective. Step two is exercise the 79.9% warrants that the Treasury holds in both companies. That would give the administration common stock in both businesses. Step three is to relist on Fannie and Freddie. The beauty of this very simple approach is that the entities will now be listed on the New York Stock Exchange. I've actually had recent conversations with the exchange. They believe it will be a matter of a few weeks for them to meet and go through the process of being listed. The accounting for the senior preferred stock repayment is really a letter amendment agreement between the Treasury and FHFA. The exercise of the warrants involves a tiny, these are deep, fraction of a penny warrants, so effectively no economic cost to the Treasury in order to do so. And magically, the companies are not listed on the exchange. And what we expect to happen in that world, particularly if the administration makes clear that the plan is to address each of the remaining issues, the capital rule, an exit from conservatorship, putting in place best-in-class management team over some reasonable period of time, the stocks will trade very well out of the gate, will give some indicative value, the mark-to-market that, for example, Howard Lutnick referred to in some commentary, and the president can ring the bell. This will be, we estimate the listed value of these companies approaching $400 billion, with the administration's Treasury stake being worth in excess of $300 billion. So let me talk about each of these straightforward components. So number one, with respect to Fannie and Freddie, the government has, by virtue of taking cash out of the entities with the net worth sweep, received an excess return on the preferred instrument. So Fannie had drawn $121 billion from the U.S. Treasury and earned an 11.2% internal rate of return with the $181 billion that's been repaid. So again, $13 billion in excess of the contractual terms of the senior preferred stock. Freddie has returned $120 billion versus the original $73 billion that was drawn from the Treasury, a 12% IRR in excess of the 10% coupon, a $12 billion excess. So combined, an extra $25 billion. So the companies have more than returned the contractual requirements of the senior preferred. The president, interestingly, has commented on this, what he refers to as theft. I quote from a letter that he wrote to Senator Paul. He says, this is November 11th of 2021, another Obama-Biden scam in legal trouble was when they announced when they allowed the Federal Housing Finance Agency, the FHFA, to steal the retirement savings of hardworking Americans who had invested in Fannie Mae and Freddie Mac. What he's referring to here is the net worth sweep. And again, later in the letter, he says, my administration would have also sold the government's common stock in these companies at a huge profit and fully privatized the companies. The idea that the government can steal money from its citizens is socialism and is a travesty brought to you by the Obama-Biden administration. My administration was denied the time it needed to fix this problem because of the unconstitutional restriction on firing Mel Watt. It has to come to an end, and courts must protect our citizens. So the president could not be more clear that he viewed the net worth sweep as theft. It's stealing the retirement savings of hardworking Americans, and literally millions of Americans. This was a benchmark security held by the classic, if you will, widows and orphans, very widely held by institutions, and the net worth sweep literally destroyed enormous amounts of shareholder value that belonged to American citizens. And the president is clearly showing his ire here. So the notion that the president would now take a step really outside the original contractual terms to wipe out the common stockholders by converting this preferred instrument that was effectively repaid, or actually repaid, but not accounted for, I think is a crazy notion and just not consistent with this president. Step two, exercising warrants. The U.S. Treasury will own, by virtue of the exercise of warrants, 79.9% of both companies, 4.6 billion shares of Fannie Mae, 2.6 billion shares of Freddie Mac, a combined 7.2 billion shares of common stock in the two companies. With respect to meeting the New York Stock Exchange listing standards, all of those standards are met by the two companies once the preferred has been deemed repaid. And the combination of accounting for the repayment of the senior preferred stock and a listing that will now enable institutions around the world to build positions in these iconic companies, actually to make them eligible eventually for index inclusion, we think will be a major contributor to the re-rating and revaluation of the two companies. Now, the beauty of this sort of simple approach is it's just a bit like Mnuchin took a significant step in ending the net worth sweep. This would be the Treasury Secretary taking a very significant step forward, but a step that has no risk. And what I mean by that is the conservatorship will be maintained, and really no change to the operations, no risk of disruption to the mortgage markets, no reduction in the government's control. In fact, the government will go from being a 79.9% warrant holder to being a 79.9% voting common stockholders. So they'll have belt and suspenders control by virtue of the conservatorship and by virtue of their nearly 80% ownership. And also, the entities will not be paying out any capital to either preferred or common stockholders. The companies will be retaining capital while the government and the Treasury figure out what an appropriate capital level for the entity. So it's an important step. It enables the administration to show American public kind of a hint of the potential significant value. And then during the administration still has 3 years. I expect they could do it much more quickly than that, take the next necessary steps to move the two entities out of conservatorship. What I think all know about the Treasury Secretary, who I think has done a superb job, is he takes a very measured approach. This would be consistent with his "let's walk before we can run" approach. Meanwhile, the president will be respecting, keeping the promises he made to his constituents with respect to protecting them from the Obama administration theft. The government will demonstrate a $300 billion incremental value in the two companies and in securities that the public can see, traded every day and discussed every day on CNBC and the various networks. In terms of estimates of value, at the current trading prices of Fannie Mae and Freddie Mac, these are incredibly cheap securities. Businesses, these are effectively a duopolistic utility-like enterprise. We like businesses that look like royalties on other people's money. This is effectively that. It's a royalty on the U.S. housing finance system. On first mortgages, Fannie and Freddie receive a guarantee fee that comprises the vast majority of their income. At the current trading prices, they're trading at Fannie's trading at 3.5 times next year's earnings, which is clearly a bargain level of capital. And by the end of the year, Fannie will already be at what we believe to be an appropriate, extremely conservative level of capital, still below the required 4.5%, but at a fortress level balance sheet, and they'll be earning, a very nice 14.4% kind of ROE on their business. Freddie Mac even cheaper. Freddie is trading at 2.5 times earnings. This is clearly 2.5 times after tax earnings. Somewhat still below the capital requirement we think the enterprises need to meet, at the sort of 250 basis point level, but they will be fairly quickly building up the necessary capital. Because of the lower capital, they're earning actually higher. Freddie's earning a higher ROE than Fannie Mae. To take a look at the government's investment in both enterprises, valuing Fannie at 16 times earnings, Freddie at 13 times, the Freddie multiple point discount reflecting that entity's need to build additional capital. We value the two enterprises at year end at about 387 billion equity value, including the preferreds around 421 billion. Combined equity value, not quite at the president's $1 trillion goal, but clearly on a path to get to the president's $1 trillion goal. And of course, why would the government want to sell an interest in these companies significantly below their value? The government doesn't have a need for cash. This is an enterprise that can compound at a rate faster than the cost of the government borrowing. So one of the important ways to reduce our country's leverage is by increasing the asset value of the assets that are owned by our government. This is a very simple, clear example of that. In order to achieve the kind of 16 and 13 times multiple, these 3 steps have to take place. The cancellation or the accounting for the redemption of the preferred, the exercise of the warrants, the listing on the exchange. Importantly, all of these can be accomplished before the end of the year, despite the government shutdown having delayed the administration. As importantly, no dilution to the government's stake in both enterprises. In order to achieve these values, however, $42, $47, $44 a share for Freddie Mac, it is important that the government, as part of this process, announce kind of a timeline for when they're going to accomplish the rest of the objectives and the release ultimately from conservatorship. We do believe the enterprises could trade at higher than these multiples once they exit conservatorship and they become literally must-own securities for institutions, and very attractive, high-yielding, dividend-paying companies that will be great retirement stakes for the investing public. Again, here the president, with a goal of November 2025, New York ring the bell at the exchange. In a few weeks, again, based on recent conversation with the New York Stock Exchange, they're taking the necessary steps so that if the government says go ahead, the president says we want to be listed this calendar year, this can be accomplished as a nice Christmas present and a nice important objective in the first year of the presidency. Really, the only question that people can ask, in our view, and there's been any kind of controversy about, is whether the senior preferred stock should be deemed repaid. So we thought we'd go into that in a little bit more depth. Just the back history here, the government stepped in, as it did with most of the big banks, as well as AIG and some other systemically important institutions, and they injected capital. Now, with respect to the banks, the terms were far less onerous, but in light of the scale of the bailout, the government extracted its pound of flesh, kind of a $1 billion commitment fee, warrants in 79.9% of both companies, a 10% coupon. Now, importantly, the senior preferred stock also had a PIK feature, where if the entities did not have sufficient cash to pay the preferred stock, the coupons could PIK. Now, interestingly, IPIK being paid in kind, the government never toggled to the PIK instrument. They just kept borrowing the entities kept, in effect, borrowing more preferred and using the preferred to pay cash dividends. But that PIK alternative is an important one that's worth mentioning. Now, by 2012, Fannie and Freddie were able to pay the 10% cash dividend. Now, interestingly, if we go to page 21 here, just at 2 quarters after both enterprises became profitable, the Obama administration surprised the market by announcing the so-called net worth sweep. And there's a lot of, without going into the whole backstory there, but the evidence that came forth was that the administration was concerned that Fannie and Freddie were about to become enormously profitable and would likely, therefore, be in a position to exit conservatorship. These were not beloved companies by the Obama administration, and they wanted to keep them from emerging. So they announced this unilateral, first of its kind in any conservatorship, frankly, in any capital markets transaction ever, an expropriation of 100% of the profits of both enterprises. And the result of that was that these entities were not able to build capital. And literally weeks after the net worth sweep began in the fourth quarter of, or just in the beginning of 2013, both enterprises were forced by their accountants to reverse a large amount of the reserves that had been taken during the financial crisis. So the history here is both Fannie and Freddie took enormous reserves after the crisis. It became clear that they're going to have to reverse those reserves. And then to prevent the companies from being in a position to emerge from conservatorship, the Obama administration basically effectively stole money from the companies and didn't account for any of these payments. That's really the background. The payments to the Treasury are well in excess of what was contractually required under the terms of the senior preferred stocks for both companies. So I'd say contractually and sort of in the spirit of fairness, what should have happened. Now, again, many people have sued to attempt to unwind the net worth sweep. Those suits have largely been unsuccessful, and the reason why is that the statute HURA that gave the government the powers over Fannie and Freddie is a statute that gave them effectively unlimited power. So we're not questioning whether the administration had the right to do what it did back then, but we're really questioning whether it was the right thing to do, and also whether on a long-term basis it's something that is sensible. So now the biggest overhang on Fannie and Freddie has been this view that since the preferred is outstanding, it's going to get converted by the government into common stock. Obviously, the conversion of these preferred stock balances would be enormously dilutive and would, largely wipe out most of the value of the common stock through that dilution. Now, importantly, the Treasury owns 79.9% of both companies. So by writing off or considering the preferred redeemed, immediately the government gets back 79.9% of the value in the warrants that they hold, because any reduction in liabilities inures to the benefit of the common shareholders. If the preferred were converted into common, we expect it would also lead to a whole host of new litigation that, of course, would make it challenging to do a capital raise or certainly a secondary sale by the government. It would be a continued overhang on the company. And I would say perhaps most importantly, we think the conversion of the preferred into common would be the kind of nail in the coffin for Fannie and Freddie in terms of whether these are investable companies. And what we do here on page 24 is we say, look, let's assume the government unilaterally converts the preferred into common. Yes, the government goes from being 79.9% owner to something in the 90s in terms of their ownership of the company. Here we're estimating that the government would own 94% of both companies instead of 80%. So the government would pick up 16% of incremental ownership. However, we believe the value that the market would assign to the companies would be substantially less than the value they would assign if the contractual terms of the preferred were honored. Sort of the damaged value of the companies would overwhelm the incremental ownership that would emerge from the conversion of the preferred. And we show a number of different examples. The company's trading anywhere between 6 and 10 times earnings, but even at 10 times earnings, if the government could attract investors the reduction in value to the government from the lower multiple would be 27% less than what could be achieved by just respecting the contractual terms. So we do not believe it's in the economic interest for the government to own 94% of a much less valuable company as opposed to 80% of a much more valuable company. Importantly, conversion of the senior preferred stock is inconsistent with the duties of a conservator. Conservatorship is a very important process whereby the government has taken over many financial institutions of various sizes to manage their either wind down or rehabilitation. And in every one of these conservatorships, the government has respected kind of the hierarchy of claims and also the contractual terms of the various capital markets instruments that are held in the various companies. And by this violation, i.e. the net worth sweep, the government has damaged this, many decades long track record for handling conservatorships properly. Why is this important? Because there will be other financial institutions that will be on the brink of failure in the future, that will need to raise capital, that will reach out to institutions to issue preferred stock, for example, or common stock. There will be no bid for those instruments if the government violates the terms of a conservatorship here. So beyond the economic downside, in our view, of converting the preferred, in this instance, it will have a follow-on effect. And I just repeat this quote from, in connection with the Fannie Freddie litigation. 87 years of FDIC, FSLIC, and RTC history demonstrate that conservators are caretakers who are not meant to operate an institution indefinitely. A conservatorship is supposed to be a, quote, temporary measure leading either to rehabilitation or to a receivership and ultimately repayment of creditors and shareholders. Nor do federal conservative receivers act for the benefit of a single preferred shareholder, in this case the government, to the detriment of all the institution's other shareholders. Such, quote, unprecedented deviations from settled insolvency practices and creditor protections undercut one of the critical foundations of a market economy, could call into question the reliability of the government as a resolution authority. Again, thinking about Secretary Bessent, this is someone who takes a very measured approach, and the idea that he would enter into a transaction that is extrajudicial, outside the authority of a traditional conservatorship, for the hope of an incremental benefit from more ownership in Fannie Freddie is a crazy notion. No Treasury Secretary is going to destroy conservatorship to make a profit, if you will, or attempt to make a profit on one instance. Just not a viable outcome. Another quote from the Cato Institute on the 4,000 precedent conservatorships. They say, in open bank assistance and conservatorships, the stakeholders' interests are protected by their contractual rights since the institution is continuing to function as an open and operating company. The provider of the assistance, formerly the FDIC for banks and Treasury for the companies, receives repayment plus interest like any creditor based on the assistance agreement. All past open bank assistance and conservatorships, all principles underlying HERA and related insolvency statutes, limited that repayment to the actual funding provided because the statutory goal explicitly is to restore the company to a sound and solvent condition. That cannot be accomplished with a confiscatory seizure of current and future value. I could not say it better myself. The point being, the preferred is entitled to be repaid with interest on its contractual terms, but it's not allowed to get more than that or become an instrument convertible into common stock, inconsistent with its terms. And I'm going to end here with, again, the letter from the president. The president could not be more clear in calling the net worth sweep a theft of the retirement savings of hardworking Americans. And he says the idea the government can steal money from its citizens is socialism and is a travesty brought to you by the Obama-Biden administration. So to summarize, I think it's a very clear case that the senior preferred stock has been repaid. That's actually a fact. It needs to be accounted for in order to implement what we're proposing here. But the beauty is that's a simple letter agreement amending the preferred, accounting for the payments that have been made. Next step is an exercise of the warrants, giving the government a major 79.9%, 7.2 billion share stake, combined stake in both companies. And then lastly, a listing on the exchange, and the exchange, of course, would be delighted to have these companies back. So I'm going to pause here. We're going to do our best to launch a space where people can ask whatever questions they have about the presentation. we will make this presentation available on X. If there are any technical issues, we'll make it available on YouTube or another platform. Thank you so much.